Hi guys, in the previous video, I talked about what trading is and what a quant does. I mentioned that quants build trading systems, and there are 4 key steps to building a system: identifying a strategy, backtesting your strategy, executing your strategy, and managing risk. In the next few slides, I will elaborate on each of these steps. A key point that I want to stress in this video is a successful strategy is more than just a good idea. You will see that consistently profitable strategies require more than just finding one mispricing or inefficiency in the market. Finding an edge in financial markets requires research, testing, and refinement to consistently produce profits. Identifying the strategy. Foremost, you need to decide which markets to trade: stocks, debt, commodities, fixed income, foreign exchange. If you're a beginner, stocks are usually the best place to start. Next, you need a good strategy to make trading decisions. Generally, finding a strategy is not hard. In fact, you can even just use strategies published in trading books, trading blogs, trading articles. Many of these strategies you will look at will fall into categories of mean reversion and trend following. Now, why would people make their strategy public? That's because the main difficulty is not finding a good strategy. It is taking a strategy, backtesting and refining it to be consistently profitable when applied to unseen data, especially once you take into account transaction costs, the variability of different markets, and other such factors. Strategies that work extremely well in backtesting can perform really poorly on live data. So, the optimization methods used to fine-tune the parameters of the strategy are a key to turning a relatively mediocre strategy into a highly profitable one. Once you've identified a strategy, you need to backtest it. Backtesting provides evidence that the strategy we've identified and optimized is profitable when applied to historical data. Therefore, backtesting helps you set an expectation of how the strategy will perform in the future. It is important to note that backtesting is not a guarantee of success. Past performance is only an indication of future performance. It does not guarantee future performance. The most important factors to perform a successful backtest are availability and cleanliness of historical data, identifying and avoiding any bias in the data, and quantifying your system's performance. We will cover each of these steps when we have a tutorial on backtesting. For now, let's take an example to understand what I mean when I say that your strategy's performance will depend on how you choose and optimize certain parameters. Let's consider a very simple mean reversion strategy. A mean reversion strategy will use simple moving averages to smoothen noisy market data over a period of time. So let's say you're using 30 days and 90 days, and you compare these two different moving averages to make trading decisions. The expectation or the hypothesis is that the longer term, in this case the 90-day moving average, is the long-term trend, and the 30-day moving average is just the fluctuations around that long-term trend. Over time, you expect the 30-day moving average to revert back to the 90-day trend. So, if the value of the 30-day moving average is lower than the 90-day moving average, you can say that the current price is too low and it's likely to increase so that the 30-day rises back up to the 90-day moving average. Therefore, this is a signal to buy. Similarly, if the value of 30-day moving average is higher than 90-day moving average, you can say that the current price is too high and it is likely to decrease so that the 30-day moving average reverts back to the 90-day moving average. Therefore, right now, it's a signal to sell. Now, I've used 30 days and 90 days here, but these are not necessarily the best values. In this case, you can try to improve your system by computing all permutations and combinations of longer and shorter period in a reasonable time interval, and then picking the best solution. As algorithms become more complex, you will have multiple parameters to optimize. It actually becomes quite challenging to find an optimal set of parameters. Now that we've talked about the mean reversion strategy, let's see how it will look in a backtest. In this chart below, the red line is the stock price, the green line is the 90-day moving average, and the blue line is the 30-day moving average. As you can see, the 90-day is a more stable trend, and the 30-day crisscrosses the 90-day trend several times. If you remember the rules of our strategy, We said that when the 30-day moving average is higher than the 90-day moving average, we expect the price to fall back because we expect the 30-day to revert back to the 90-day moving average, and that is a signal to sell. So we see right here, the 30-day moving average crosses the 90-day from below and becomes higher than the 90-day moving average. Therefore, this should be a good point to sell. This is actually a signal to sell. Similarly here, we see that the 30-day moving average crosses the 90-day moving average from above. Therefore, this should be a good time to buy. This is actually a signal to buy. Now, if we see that based on these signals, if we had actually sold and bought the stock, this would have been a good signal. We would have actually made profits here. So for this time period, the strategy would have performed well. Now, once we have backtested our strategy and our strategy is deemed to be free of any errors, it is time to build an execution system. An execution system is the means by which the trades that your strategy generates are sent and executed by your broker. I mentioned what a broker does in the previous tutorial, but I will reiterate here. A broker is an individual or a firm that executes buy and sell orders that are submitted by you, and he charges you a fee for this. The broker actually acts as a liaison between you and the exchange. So for example, if you want to buy Apple shares, then your broker will communicate this to the exchange, find a seller, buy those shares on your behalf, transact them back into your account, and he will charge you a fee for this service. There are many ways to interface with a brokerage. It can range from calling your broker on the telephone to a fully automated API provided by your brokerage. There are discount brokers like Interactive Brokers or Zerodha where they offer an online trading account. So now, why do we need a good execution system? We need a good execution system to minimize transaction costs. Transaction costs can be many types: commissions, slippage, spread, and they can have a significant effect on your algorithm's performance. For an example, let's consider commissions, the fees that is charged by a broker to execute your trade. You can actually optimize the fees that you pay based on what you want to trade and the volume you want to trade. In the figure below, we compare 3 different types of discount brokerages that are popular in the US. And as you can see, they all offer different fee for trading, but they also have different requirements. For example, initial funding, what kind of contracts they trade, and you can optimize your cost based on what you really want to trade. Finally, once you have your trading and execution system in place, you need to set up a risk management system. What is risk? Risk includes nearly everything that could interfere with trading implementation: faulty algorithms, defective implementation, system malfunction, personal biases, technology risk, brokerage risk. Let's take an example. A very simple type of risk, fat finger risk. So let's say you wanted to buy 100 shares of Apple, but you mistakenly type 1,000 shares. Now, you definitely did not want to buy 1,000 shares. You may not even have the capital to buy 1,000 shares. And in the worst case, you may end up buying those 1,000 shares and not even be aware that you bought 1,000 shares. A very simple check in this case could be to have a window pop up that says you are buying 1,000 shares. You could set a limit and say, if I buy anything over 100 shares, then have a window pop up for confirmation saying you're about to buy something like this. This is a very simple example of a pre-trade check. Risk management actually includes both pre and post-trade checks in your algorithm, assigning reasonable stop losses, or allocating your capital optimally. As a bigger example of what a faulty algorithm can do, consider this. In 2012, a well-known trading firm, Knight Capital, had a buggy trading algorithm. This algorithm started trading and pushing erratic trades on almost 150 different stocks. They actually made over 4 million error trades. And in 30 minutes, the firm lost 440 million. That is 4 times the profit they made in the previous year. So effective risk management means you create a broad protection for your algorithm. You avoid buggy algorithms, you avoid bugs in your algorithm, you avoid error executions. So you protect yourself against catastrophic losses without compromising on execution speed or profitability of your system. So in this video, I've tried to give you an overview of the steps required to build a trading system. As you can now see, the key to developing a good, profitable strategy is more than just finding the most innovative or the most exceptional strategy. A great strategy may perform poorly if not well optimized. A well-optimized and back-tested strategy may just fail due to poor execution or high execution costs. Or you may not even have proper checks in place to catch errors or bugs. So the job of a quant does not just stop at a good strategy. You can actually just pick a strategy out of a book, but you can apply your programming skills, your data skills, your math skills to actually just optimizing it, to building a proper execution system, and putting good checks in place and building a backtesting system. In next tutorials, we will cover each of these steps in detail. As I mentioned before, we will be taking a simple trend following strategy as a sample, and we will work up to writing, optimizing, backtesting, and executing that strategy. So that's all I have for you this time. If you have any questions about the material we covered, or if you have any feedback, please leave them in the comment section below. You can also send us an email. Our email is on the screen. And finally, do follow us on Facebook or Twitter. The links are below. We'll have more tutorials for you soon. Stay tuned.